Hey YouTube, it's Zach. The Financial Consumer Agency of Canada just released a guideline on how to deal with existing mortgage loans in exceptional circumstances. This is a sign that over the next little while, things are going to get really fun. A government agency doesn't come out publicly and ask banks to go easy on people with fees. These guidelines are issued to federally regulated financial institutions, pretty much banks, but not private lenders. The guideline is looking into people with existing mortgages on their primary residence only, so they are not helping out over leveraged investors in this case. So if you have a primary residence and experiencing hardship, help is here. This new guideline is not discriminating based on mortgage type. The a la carte menu has something for everyone, whether you have a variable rate mortgage with a fixed payment or a variable payment, all fixed rate mortgages, and anyone who's about to renew soon and realizing the sheer power of a 6% interest rate. Tiff Macklem texted me saying if this video gets 100 likes, he'll be dropping the rates by 1%. So do yourself and everyone a favor and smash that like button. Let's dive right into it and see what Krista has in store for us. The Financial Consumer Agency of Canada, which I will call the agency from here on, is expecting banks to waive penalties when a consumer makes a lump sum payment. If you have a variable rate mortgage with a fixed payment, for example, when your mortgage was originated, a portion of that payment went to interest and a portion went to principal. Since Bank of Canada has been raising the rates, the principal portion of your payments started to shrink. That is why your amortization got extended. This is where the headlines of 90-year amortizations come from. I'll be making a video on that, so make sure to subscribe to the channel so you don't miss out. If you don't subscribe, there is a chance that YouTube is not going to show you my pretty face again, so you'll miss out. Make sure you're subscribed. In this case, when the time comes to renew your beautiful 90-year mortgage, you'll need to most likely make a nice lump sum payment to make sure you bring your amortization back to a minuscule 30 years. The agency is hoping banks would not charge you a fee when making that payment. The agency also wants banks not to charge a fee for these distressed consumers selling their principal residence. This means they are expecting more people to sell their homes, not downsize or upsize, but to leave the home ownership market and go rent. If you are to sell now and basically move, your mortgage would port to the new property that you purchased and you won't be paying that big of a fee. But in this case, the agency is expecting a large number of people to sell their homes and rent. God help the tenants. As if we have so much rental supply, this game of musical chair just keeps getting better. Is there anything else we can do to make this a bit more exciting? That's a great idea. On to negative amortization. If you are one of the lucky ones and got a variable rate mortgage when the rates were close to zero, you're experiencing what we call a negative amortization. I made a very popular video on this when McDaddy Tiff started jacking up the rates in an effort to fix Canada, and I broke down the options that Canadians had with their mortgages when they hit the trigger rate. I'll put a link to that video at the very end so you can watch. What negative amortization does is it adds a little bit of the leftover interest back onto your principal after you hit the trigger rates and if you decide not to do anything about it. So basically you'll have a mortgage that's growing. Initially, a portion of your payment went to the principal and the portion went to interest. With each rate hike, this principal portion started to shrink. By the end, you started adding to your actual principal. So your mortgage started to grow. And what the agency is saying here is do not charge an interest on that interest rate. They want the banks not to blend in the new interest to the principal and start charging interest on that too. My concern here would be some people might be moving banks, refinancing, and may end up getting their amounts mixed up by the banks somehow and pay interest on that interest without knowing. Not sure what kind of safeguards there will be here to protect consumers, but basically the agency is saying please don't do it. The guideline is asking banks to be proactive, reach out to consumers, check for signs of early distress, and be fair in their dealings. The good news is your credit score should not be impacted if you find yourself in these exceptional circumstances. The agency is asking the banks not to go gaga on your credit score basically. My takeaway from this guideline is buckle up. Things are going to get wild, it looks like. If you haven't subscribed to the channel after watching this long, just do it. This is the video I mentioned earlier and I really think you're going to like it. Thank you so much for watching and I'll see you in the next one. Bye.